Welcome back to the deep dive. Today, we are staring down the barrel of what is, let's be honest, probably the single most stressful, expensive, and confusing transaction of your life.
It is the big one. Yeah. The one that keeps people up at night, for sure.
We are talking about buying your first home, and specifically trying to figure out how to do this in the wild landscape of early 2026.
Right.
Because I don't know about you, but when I look at the market right now, it feels like I need a PhD just to understand the listings. You've got fluctuating interest rates, new government rule.
And then you have the advice from every single person you know.
Oh, the Uncle Bob factor.
Yeah, exactly. Everyone has an opinion based on what the market was like 10 years ago. But if you try to apply that 2016 logic to 2026, you are going to get hurt. It's a different world.
So that's our mission today. We have a stack of sources here. Expert guides, legal checklists, mortgage strategy transcripts, all for Canada.
Yeah.
And we're going to cut through that noise.
We want to take you from being that person,
Anxiously scrolling listings at 2 in the morning to being a prepared professional level buyer.
And we're going to do that by breaking down the financials, the strategy, and I think most importantly, the team you need around you.
Speaking of the team, that was the first thing that really jumped out at me in the research. I always kind of assumed the process was, straightforward.
Yeah.
You get a realtor, you get a loan, you buy a house.
Right.
But the sources kept talking about this massive friction point, this silo problem.
Yes, the fragmentation of the whole process. That's it.
Okay, so break that down for me. Because in my head, shouldn't everyone involved in selling me a house be on the same page?
You would think so. But traditionally, the industry operates in these completely separate boxes. You hire a realtor from company A, you go to a mortgage broker at company B.
Maybe an insurance agent at company C.
Exactly. And these people don't work together. They don't share information. Half the time, they have never even spoken to each other.
So you're just the messenger running between all of them.
You are. And that is where the real danger is. We saw these horror stories in the research where a realtor, eager to close a deal, pushes a client to make an offer.
An offer that might not actually work financially.
An offer that the mortgage broker knows isn't viable. But because they aren't talking, the buyer signs, puts down a deposit, and then the financing it falls through.
And the deposit is just gone.
Gone or tied up in court. It is a complete mess.
That is genuinely terrifying. So is there a better way? I mean, surely someone has figured out how to fix this.
Well, this is where the research pointed us to a really interesting case study. It's a firm called Moonerus Financial Services.
Okay.
They seem to have recognized this exact failure point and just flipped the entire model on its head.
How? What do they do differently?
Instead of all those separate silos, they operate as one integrated team. You have licensed mortgage brokers and licensed real estate brokers working under the same roof on the same team.
So wait, the person who is finding me the house actually knows in real time if I can afford the house.
In real time, it just eliminates that lag, that gap between, I love this kitchen and, oh, God, can I get the loan? It's a safety mechanism.
That alone seems like a huge advantage.
It is. But what I found even more fascinating about Moonerus was the leadership profile. The CEO, his name is Mansour, isn't just a real estate guy or a mortgage guy. He's also a qualified life insurance broker.
Okay, I have to be honest, that feels like a bit of a weird detail to highlight. I mean, I'm buying a condo, not a life insurance policy. Why does that matter to me?
It sounds tangential, I know, but it's actually central to the entire philosophy of risk. When you buy a home, you're not just acquiring an asset. You are acquiring a massive liability.
Hundreds of thousands of dollars in debt.
Right. And you're probably doing it with a partner. But what happens if something happens to that partner? If one income suddenly disappears, that mortgage becomes a ticking time bomb.
And most brokers don't think about that part.
They're transactional. They sell debt. Because Moonerus is led by someone with that risk management background, they don't just see the transaction, they see the liability. They're thinking about the protection plan before you've even signed the offer.
That makes so much sense. It's the whole financial picture, not just the happy closing day photo.
That's it. And we'll come back to how that helps later. But before we can even get to the team, we have to talk about the bank account.
Part 1, the financial reality check. I read this section on the comfort zone. And yeah, it was a wake-up call.
It's the classic trap. There is a huge gap between your pre-approval amount and your actual comfort zone.
The bank might tell you, congratulations, we'll lend you $900,000.
And that is the ceiling. It is not a target.
But if the bank thinks I can afford it, why shouldn't I trust them? They're the math experts, right?
They are math experts, but they aren't your life experts. Lenders use two key ratios: First is GDS gross debt service.
Okay, and in plain English, that's
Your mortgage principal, interest, property taxes, and heating costs. All that should not eat up more than, say, 39% of your gross monthly income.
39%. Wow, that already seems high.
It is. And then there's TDS total debt service. That adds in your other debts. Credit cards, car payments, student loans. The cutoff there is usually 44%.
But that's based on pre-tax income.
That's the rub. It doesn't account for income tax or food or the fact that you might want to, I don't know, go on vacation once a decade.
Right. The bank doesn't care if I'm eating instant noodles for the next 25 years as long as they get paid.
Correct. So you have to figure out your own number, and you need to factor in the hidden costs of ownership. The sources all mention the 1% rule.
I saw that. Is that 1% of the mortgage amount?
No, it's 1% to 3% of the purchase price of the home, set aside, every single year for maintenance.
Wait, run the math on that for me.
Okay, if you buy a $600,000 condo, you should be budgeting about $6,000 a year. So $500 a month.
Yeah.
Just for things breaking.
The dishwasher dies, the roof leaks.
The strata fee goes up. Exactly. If you don't budget for that, you're putting home repairs on a credit card at 20% interest. And that is a spiral.
That is a sobering number. Okay, let's talk about the other gatekeeper. Your credit score. I feel like everyone checks their score on their free banking app now.
And those apps are great for a general health check, but they can be misleading. Most of them show you a Vantage score.
But lenders use something different.
Right. Lenders in Canada almost exclusively use FICO scores. And they can be different. The algorithms just weigh things differently.
So my app might say 710, but the lender pulls a 680.
It happens all the time. And it matters because while there are minimums to get a loan, usually around 620, the score directly dictates your interest rate. A better score literally saves you money.
How much money are we talking?
Tens of thousands. Over the life of a mortgage, the difference between a good rate and just a fair rate can easily be $20,000 or $30,000 in pure interest.
Okay, so protect the score. Don't go buying a new car right before you apply for a mortgage.
Absolutely not. Freeze all your credit activity. And speaking of freezing, let's talk about the emergency fund trap.
This one scared me. The urge to just dump every single penny you have into the down payment to get into the market.
It's the house poor phenomenon. You get the house, but you have $0 in the bank. The sources are so clear on this, you need a separate emergency fund. 3 to 6 months of living expenses.
That you do not touch for the down payment.
You do not touch it. Because if you lose your job the month after you move in...
You lose the house. That fund is the only thing standing between a temporary setback and, well, foreclosure.
Exactly.
Okay, so we're saving, we're protecting our credit. Now let's look at the toolbox. The government has actually changed the rules quite a bit for 2026. What do I need to know?
The landscape has definitely shifted to try and help first-time buyers. The biggest weapon in your arsenal right now is the FHSA.
The First Home Savings Account. I've heard this called the magic account.
It is magic. It's because it's a tax loophole that's actually, legal. It combines the absolute best parts of an RRSP and a TFSA.
How so?
When you put money in, you get a tax deduction. It lowers your taxable income for the year, just like an RRSP, so you get a refund.
Okay.
But usually with an RRSP, you pay tax when you take the money out. With the FHSA, when you withdraw it to buy a home, it is completely tax-free.
So it's tax-free going in and tax-free coming out.
It's the only investment vehicle in Canada that does that. It's incredible.
That is huge. What's the catch? Is there a limit?
Yep. You can contribute $8,000 a year up to a lifetime max of $40,000. And if you have a partner, you can both do it. That's $80,000 for your down payment.
And does this replace the old RRSP homebuyers plan?
No, it stacks right on top of it.
Yeah.
You can still pull up to $60,000 from your RRSP. But, and this is a big but, that RRSP money has strings attached.
It's repayment. You have to pay it back.
Yes. You have to pay it back to yourself over 15 years. If you miss a payment, the CRA treats that as taxable income for the year. It can turn a tax break into a tax bill if you're not careful.
Whereas the FHSA has no repayment.
No repayment required, so the strategy is clear. Max out the FHSA first.
Got it. Now, what about the mortgages themselves? I keep seeing headlines about 30-year amortizations.
This is a big one. As of the recent changes, first-time buyers with insured mortgages, so less than 20% down, can now extend their amortization to 30 years. It used to be capped at 25.
Okay, so simple math. Longer time to pay means lower monthly payments. That sounds good on the surface.
It helps with cash flow, for sure. It might lower your payment by a few $100 a month, which can help you pass the stress test. but you have to understand the cost.
You're paying interest for 5 extra years.
For 5 extra years. On a typical mortgage, that could mean paying an extra $50, $60, even $70,000 in pure interest over the life of the loan. You're buying flexibility today for a very high price tomorrow.
A painful trade-off. What about the price cap for insured mortgages?
Another huge change. The cap is now $1.5 million. Previously, if a home was over $1 million, you had to have 20% down, no exceptions. Now, you can buy up to $1.5 million with less.
But it's not just a flat 5% down on the whole thing, right? It's a tiered system.
Correct. You pay 5% on the first $500,000, then you pay 10% on the portion between $500,000 and $1.5 million. It's still a lot of cash, but it's much more achievable than a flat 20%.
Okay, let's pivot back to the process. We've got our financing strategy. Now we need to find the house. And this brings us right back to that silo problem and the team.
This is where the rubber meets the road. You can do all the spreadsheet math you want, but if your team isn't perfectly synced up when you go to make an offer, you are so vulnerable.
So let's look at the Munoz model again as an example. We know they have the mortgage broker and the realtor on the same team. How does that practically change the offer process?
Think about the speed of the market. You see a house on Tuesday. Offers are due Wednesday afternoon. In the old model, you're frantically calling your broker, who might be at lunch or busy. Your realtor is pressuring you. You're guessing.
And with the integrated model?
The conversation happens instantly, internally. The realtor says, we want to offer $850. The in-house mortgage broker immediately runs the file against the specific property taxes and condo fees of that exact unit and says, yes, verified, or no, that pushes the GDS ratio too high.
So you can move with the confidence of a cash buyer.
That's it. And I want to go back to that insurance piece because I think it's so important. If I go with the standard broker, do they usually talk to me about life insurance?
To protect the mortgage.
To protect the debt, yeah.
Rarely.
They'll sell you the loan. Maybe they'll offer you mortgage creditor insurance from the bank, which is, frankly, it's a terrible product.
Why? It pays off the mortgage if something happens.
It protects the bank, not you. The payout shrinks as you pay down the debt, but your premium stays the same. Mansour's approach at Muneris, because he's a qualified life insurance broker, is totally different.
What's the alternative?
He's likely guiding you towards personal term life insurance that protects your family. The payout is fixed, it covers the mortgage and leaves extra money behind. It's a holistic view of financial safety that you just don't get from a transactional lender.
It really is a sleep-at-night factor. For anyone listening who wants to see what that integrated approach actually looks like, where do they go?
The team is at Muneris Financial Services. The website is easy. It's just muneris.com.
Yeah.
Or you can email the CEO directly, mansour@muneris.com.
And a phone number?
Yep, just call him, 778-898-3202. It's really worth a conversation just to get a handle on your own risk profile.
Absolutely. Okay,
Yeah.
Let's assume we have the team, we found the house. Now we have to write the offer. The sources list the big 5 of an offer: price, deposit, possession date, irrevocable. And the big one: conditions.
Conditions are your escape hatch. They are your safety net. And in a hot market, there is immense pressure to drop them to make your offer look cleaner,
That no conditions offer. I'll take it as is.
which is financial suicide. You need a financing condition. Even if you're pre-approved, the lender still has to approve the property. If they think the house is worth 50 grand less than you offered,
They won't cover the difference. You have to come up with that cash.
instantly. And without that condition, you are legally on the hook to close the deal.
And the home inspection.
Non-negotiable. Don't ever skip it. And for condos, the status certificate. This is the financial health report of the entire building. You have to see it.
Got it. Okay, offer accepted. Now the mortgage is real. Fixed versus variable.
The eternal debate. Fixed gives you certainty. Your payment is locked in for 3 or 5 years. Variable fluctuates with the Bank of Canada's prime rate.
Historically, variable saves you money, right?
It has, but as we saw in the last few years, if rates spike, your payment can go through the roof. It really comes down to your personal risk tolerance.
How well do you sleep at night with that uncertainty?
Exactly. And then open versus closed, 99% of people take a closed mortgage.
Why is that? Open sounds so much better, more flexible.
It is flexible. You can pay it off anytime. But the interest rates are astronomical. Closed mortgages have much, much lower rates, but you face a penalty if you break the contract early.
Okay, we're almost there. Closing day. This is the part of the script where we deliver the bad news about sticker shock.
The hidden costs. You need to have cash on hand, separate from your down payment of about 1.5 to 4% of the purchase price.
Ouch. What is eating up all that money?
The big one is land transfer tax. Depending on where you live, the government takes a slice just for the privilege of buying a property.
And in some cities like Toronto, you get hit twice.
You get a municipal tax and a provincial tax. Now, there are rebates for first-time buyers, which helps, but you still need to budget for the gross amount to be safe.
And then there are the lawyers.
Legal fees, title insurance, which protects you from fraud,
Right.
and something called adjustments.
Adjustments always confuse people. Break that one down.
It's basically you settling the tab with the seller. If the seller already prepaid their property taxes for the entire year and you move in on July 1st,
You owe them for the second half of the year.
you have to write them a check for that on closing day.
So the moral of the story is do not empty your bank account for the down payment. You need that extra closing cash.
Absolutely.
This has been a lot. We've covered the financial prep, the silo problem, the integrated solution with Muneris, and the nuts and bolts of the offer. But I want to close on a philosophical note. Interest rates in 2026 are what they are, and a lot of people are sitting on the sidelines just waiting.
And that is a very risky game to play. The sources have this great phrase for this.
What's that?
Date the rate, marry the home.
I like that. What does that mean in practice?
It means if you find the right home for you and the numbers work for your budget today,
With today's numbers.
with today's numbers. Don't obsess over the interest rate. You are marrying the home. That's the long-term asset that will appreciate. You are just dating the rate.
Because mortgages aren't forever. They have terms.
Exactly. Most terms are 3 to 5 years. If rates drop in 2 years, you can break the mortgage and refinance. Yes, there's a penalty, but you do the math. If the savings outweigh the penalty, you switch.
But if you wait on the sidelines for rates to drop,
If you wait, guess what happens? Everyone else who's waiting rushes back into the market. Demand spikes and home prices go up. You might get a lower rate, but you'll pay $50,000 more for the exact same house.
you can change your rate later. You can't go back in time and buy the house at today's price.
That's the takeaway right there. It's about strategy, not timing the market.
And having the right team over everything else. Don't try to do this alone.
Please don't.
Absolutely. If you want to explore that integrated model we discussed, where the mortgage, real estate, and risk management are all under one roof, reach out to Muneris Financial Services.
That unique combination of expertise is really hard to find.
You can call them at 778-898-3202 or find them online at muneris.com. Get the right advice, protect your liability, and get into that home.
Confidence comes from preparation.
Thanks for listening to The Deep Dive. Good luck out there.